to the channel, traders. In today's video, we're going to dive into one of the most powerful trading signals in the Forex market, the Golden Cross strategy. Whether you're an experienced trader or just starting your journey, mastering this signal can take your trading game to a whole new level. Here's what you'll learn in this video: what the Golden Cross is and why it's crucial for traders like you. How to use this signal effectively to boost your trading strategy. Real-world examples with charts so you can see exactly how the Golden Cross plays out in action. Before we jump in, be sure to hit that like button, subscribe to the channel, and ring the notification bell so you don't miss any of our latest trading tips. Let's get started. What is the Golden Cross? Let's start with the basics. In trading, the Golden Cross is a powerful chart pattern that indicates a long-term bullish trend in the market. It happens when a short-term moving average, like the 50-day MA, crosses above a long-term moving average, typically the 200-day MA. This crossover is often seen as a signal that upward momentum is gaining strength, and it's a key signal that many professional traders use to time their entries. So why is this important? Well, when the 50-day MA crosses above the 200-day MA, it suggests that recent price action is stronger than the long-term trend. Essentially, it's a signal that the market's short-term momentum is outpacing its longer-term movement, indicating a potential shift in market sentiment. This is especially crucial in Forex, where timing is everything. The Golden Cross is considered a bullish signal, meaning that the market is likely to continue moving upward. The market sentiment shifts, and buyers begin to dominate, pushing prices higher. But let's be clear, not every Golden Cross will lead to a huge rally. And it's not a foolproof strategy. It's a powerful tool when combined with other technical indicators, and that's exactly what we'll explore next. Now that we've defined the Golden Cross, let's talk about how to use it effectively in your trading. The key to maximizing the Golden Cross is not to rely on it alone. You'll need to combine it with other analysis techniques, and most importantly, be patient. Step 1. Identifying the signal. The first thing to look for when trading the Golden Cross is when the 50-day moving average crosses above the 200-day moving average. You'll typically notice this when the shorter moving average starts to move upwards, breaking above the longer moving average. This signals a shift in momentum. This process is gradual, and the Golden Cross doesn't happen instantaneously. Keep a close eye on the chart, especially on pairs that show signs of consolidation or a market shift. It's crucial to watch for the crossover to confirm that the trend is actually shifting from bearish to bullish. Step 2. Confirm the Golden Cross with other indicators. Once you spot the crossover, don't rush to jump into a trade right away. The Golden Cross is a fantastic signal, but confirmation is key to avoid false breakouts. Here's how you can confirm the Golden Cross signal. Volume. Look for an increase in trading volume at the time of the crossover. An uptick in volume suggests the trend is gaining strength. RSI, Relative Strength Index. If the RSI is above 50, it indicates bullish momentum. However, if it's above 70, the market might be overbought. Proceed with caution. MACD, Moving Average Convergence Divergence. When the MACD line crosses above the signal line, it serves as a strong confirmation of a bullish trend. Using these indicators can significantly reduce the chances of falling victim to fakeouts or false breakouts, which are common in volatile markets. Step 3. Timing your entry. So, the Golden Cross has occurred, and you've confirmed the signal. The next step is to find the best timing for your entry. Many traders will jump into the market immediately after the Golden Cross, but this can be risky if the market hasn't fully confirmed the move yet. Here's how to refine your entry. Wait for confirmation. Don't rush into the trade as soon as the crossover happens. Wait for the next candle to close above both the 50-day and 200-day moving averages. Additionally, look for volume confirmation to ensure there's enough momentum behind the move. Identify support and resistance levels. Examine the chart for key support and resistance zones. These levels can act as guides to spot potential reversal points and give you a clearer picture of where to enter or exit the trade. Use Fibonacci retracement. If the price pulls back after the crossover, consider using Fibonacci retracement levels, such as 38.2% or 50 cents to find an entry point. This strategy can improve your risk-to-reward ratio by entering closer to a support level. By combining these steps, you increase your chances of entering the market at the most opportune moment, maximizing your potential for profit while managing risk effectively. Step 4. Set your stop loss and take profit levels. After entering the trade, risk management is crucial. The golden cross is a strong indicator, but it's still important to manage your risk properly. Stop loss. Place your stop loss just below the most recent low or the key support level. This will protect you if the market moves against you. Take profit. For take profit levels, look for the next resistance level or a key round number. Many traders also use a fixed risk to reward ratio, such as 1:2 or 1:3, to set their exit point. This ensures your profits are locked in and your losses are limited. Real-world examples and golden cross in action. Now that we've covered the theory behind the golden cross, let's take a look at some real-world examples. I'll walk you through a couple of Forex charts to show how you can spot and use the golden cross in real market conditions. Example 1. Euro USD, bullish signal. Let's take a look at the Euro USD currency pair. On the chart, you'll see that the 50-day moving average, MA, crosses above the 200-day MA, creating the golden cross. At this point, the market is signaling that the short-term trend is stronger than the long-term trend. Notice how volume increases as the crossover happens, confirming a shift in momentum. Additionally, the RSI, Relative Strength Index, moves above 50, signaling bullish strength, a strong confirmation. After the crossover, the price begins to climb. This presents an opportunity to enter the market on the next retracement. You could place a stop loss below the previous low or near a support level and set your take profit at the next resistance. Over the next few hours, Euro USD continues to rise, confirming the golden cross and providing an excellent opportunity to catch the trend early. Example 2. GBPJPY. On the flip side, not every golden cross will lead to huge gains. Let's look at the GBPJPY currency pair where we see a golden cross, but the price doesn't continue in the direction we expected. In this case, the price initially moves higher after the crossover, but soon after, it reverses and begins to drop. This is a false signal, and it's an important reminder that the golden cross isn't foolproof. In this scenario, using a stop loss just below a recent low would have helped minimize the loss. The key takeaway here is the importance of confirmation. Always use additional tools to validate the golden cross and avoid trading off a single signal. In conclusion, the golden cross is one of the most powerful technical indicators in Forex, but like any strategy, it's not without its risks. By combining the golden cross with other indicators like RSI, MACD, and volume, and by practicing sound risk management with stop losses and take profit levels, you can greatly increase your chances of success. Here are the key takeaways. Wait for confirmation. Don't enter right after the crossover. Look for volume, RSI, and other indicators to confirm the signal. Be patient. Not every golden cross leads to a massive rally. Wait for the right entry point and use technical tools like Fibonacci and support resistance to fine-tune your trade. Risk management is crucial. Always set stop losses and take profit levels to protect your capital and lock in profits. By applying the golden cross strategy in your Forex trading with discipline and precision, you'll be able to spot strong trends and make more informed, profitable trades. If you enjoyed this video, don't forget to hit like, subscribe to the channel, and turn on notifications so you never miss our latest tips and strategies. If you have any questions or want to see more examples, leave a comment below. We'd love to hear from you. Happy trading, and we'll see you in the next video.